good day, everyone. Thank you very much for joining me. Today we're going to take a little deep dive into the state of the M&A market as of the end of Q2 2021. Before I begin, don't forget, subscribe to the newsletter, Enterprise Value. The link is in the description. If you have any questions, please reach out to me at value@valorum.ca or visit my website at www.valueacceleration.ca for more resources on value growth, exit planning, and corporate finance topics. So the last time we took a look at the market was in Q1, and we did a summary then of what the market was like at the end of 2020. So I'm not going to spend a lot of time talking about that right now. Today, what we want to talk about is what the current market is like as of the end of Q2 2021. So that's the April, May, and June time period. And we're, of course, just finishing off Q3. But at least this will give us an idea about what's changed since the end of 2020 over the past 6 months and sort of where we are. And one of the other things that we're going to cover today is also what is the outlook for the end of 2021. So is it positive? Is it negative? Etc. So right now, what is the market like? And the first chart there, we take a look at the deal counts, and it's segregated by company EBITDA. And the M&A market is active. And as you can see on the high end of companies that have a high degree of EBITDA, the number of deals is actually higher. So for anybody with EBITDA greater than $4 million US, the number of deals has risen all the way up into the $25 million range. And I should mention, while we begin, this is coming from information that's coming from the AM and AA reports. So it's largely US centric, but I think it's applicable to the Canadian market as well. The other thing that's kind of noteworthy is that on the for smaller companies with cash flows of less than $500,000 or less, the number of deals significantly rose over last year. So 2020 deal count was 20, and in the first 6 months of 2021, there have been 42 deals. So that's actually very positive. And in general, the dollar value of the deal flow is also increasing, and we see similar patterns for larger companies. How the deal flow, just in terms of pure dollar values for the larger companies with a larger amount of EBITDA, is significantly higher. And I think what that's really indicating is that there's a couple of reasons for that. Number one, I think there's a lot of money that's sitting on the sidelines. So if you have a company with a large degree of cash flow, that's going to be very attractive to investors. And I think as well, now that we're heading into 2021, 2020 was obviously a challenging year, and we still have some challenges. But I think we're far enough into sort of that. That post, the original lockdown was Q2 of 2020. And so now we're, beyond a year from that. So, for a lot of those businesses, they have a track record that's kind of past that point. And I think that helps to, increase the confidence of the market. Helps to increase confidence from the buying public in terms of wanting to go ahead with the deal and the multiples, and we're going to talk about the multiples. So I think overall everything's heading in a good direction. So what was the financial performance of companies in the current deals? And this is sort of interesting, this top chart here, which takes a look at cash flow or EBITDA percentages. And, generally speaking, you're going to probably see there's a positive correlation there. So you're going to expect that, to a large degree, larger companies are going to have maybe better financial performance. But what's really important here in this chart to take a look at is that there's that whole kind of middle ground of companies with $500,000 to cash flow to $15 million, where it's not only not flat, but it's actually sort of sloping downwards. And I think so if you look at that, those businesses that are like have $4 million of cash flow all the way up to $15 million in cash flow, they actually have some lower EBITDA percentage multiples than some of the smaller companies. I'm going to speculate here, but I think part of that's because sometimes growing is sort of like a step cost function. It's like stepping stairs, and some of those companies they need to make investments to get to the next level. And you see, like, for example, that companies with cash flows of $15 to $25 million US were doing very well with EBITDA margins of about 30%. So I think what may be happening there is that you have to make those investments, but then eventually it does pay off, and you do get returns on investments as you keep growing. So I'm speculating, but that's probably what's going on there. So let's take a look at multiples. So before we begin, I'll just give the usual caveat about multiples. Multiples are going to be, for any given company, going to be predicated based on what's going on in the particular industry and what's going on with that particular business. For example, is it growing fast? What's going on with management? What are the risk factors of that particular company? So don't read too much into this for any single company. These are multiples for the market in aggregate. And the top chart there is important because what it's indicating to us, the blue line there represents the multiples that are occurring now in 2021 versus 2020, which is the yellow or the gold line. And as you can see, especially again at the higher end, we're seeing higher multiples there. So for example, in the $6 to $10 million range of EBITDA, multiples have increased from, in aggregate, from 8.7 or to 8.7 from 8.1. At the very high end, $15 to $25 million in cash flow, multiples have gone over 10 times versus the 7.4 a year ago. So, and I think part of that maybe there's higher volumes, so you're getting a greater sample. But I also think that there's generally some better companies that are transacting as well. There's just a more desire or more penchant to pay higher multiples for those quality of earnings that are out there. I think the other categories that we see there below $6 million in cash flow, the multiples are roughly the same. I don't think there's any real statistical difference, but we can definitely see at the higher end, there's definitely improvement. And the lower chart shows what's going on with revenue multiples. I'm not the biggest fan of revenue multiples, but you can see in that chart that, again, at the higher end, revenue multiples have also expanded. So which industries are the most active and which type of buyers? So here, this report really breaks down the different types of buyers. And so let's just run through them very quickly. So corporate buyers would be basically, other corporations that either could be competitors, could be businesses that are looking to expand into different areas. There's private equity platforms. So when we talk about private equity platform, we're talking about private equity moving into a sphere that they have not been in before. Private equity add-ons means that they are making purchases of businesses in areas that they already have investments. So they're looking to expand either geographically or vertically or horizontally. There's probably some strategic reason for those acquisitions. Individuals. So again, we certainly see that at the Main Street level, but also in the middle market as well. Sometimes you will get individual buyers with obviously if they have the wherewithal, and they may come in and they may be looking for those businesses. Independent sponsors, sort of a growing area, and that's basically where there's either sort of like a consortium of investors, and they'll probably go find their own financing, but they're looking for deals. Family offices are obviously families that have either have sold their business and looking to invest in other businesses, or it's like a type of private equity, but it's something that's very specific and unique. And of course, internal buyouts are also popular, but you're not going to see a lot of them necessarily represented by this group of respondents. So I think they're something to keep in mind, that they're a little bit underrepresented in this report. But internal buyouts would be selling to management, selling to key employees, or ESOPs. But a lot of the respondents, members of the AM and AA, are dealers. And they're probably going to be dealing with third-party exits as opposed to internal buyouts. So they're going to be a little bit underrepresented in this, but important to keep that in mind. So, and if we take a look at the particular industries that are active, so number one is going to be healthcare, medical, and pharmaceuticals in terms of percentage of deals. Manufacturing is number 2. B2B business services is number 3. And coming in a fourth is construction and construction materials. And then you can see there's a whole group of them that are under 10%. So still somewhat significant. B2C services is number 5. And then software as a service is comes in at 6, but is at 5%, and the rest are under 5%. But you can see that, the percentages have changed for each of the different categories. So one of the big growers was construction and construction materials. You can see that is 10% of deals so far in 2021 versus 6% of deals in 2020. So that has grown. One of the bigger decliners actually was healthcare, medical, and pharmaceuticals. So even though it's the biggest, it only represents 17% of deals. But I think what's important to understand is that like in that particular case, I think that's really a reflection of the fact that the deals that are going on are more widely represented by different industries. So you can see like the dollar value, for example, in healthcare, medical, and pharmaceutical actually went up from the year before. So it's not a shrinking thing. It's just, relative to other areas that are growing. Manufacturing, is sort of the opposite of that. So it is, there were a smaller percentage of deals in 2021 versus, we take a look at the deal values. Well, it's about half in terms of just pure deal values. So I think some of those things are going to change from year to year, but I think it's important to sort of, appreciate that some of that can change. So let's just take a look at some of the bigger sectors and who are the buyers in them. So healthcare, medical, and pharmaceutical, we can see that corporate buyers represent about 55% of the buyers. Okay. Number 2 is going to be private equity platforms, and number 3 is private equity add-ons. So if we combine private equity together, That's about 31% is going to be private equity, either platform or add-on. In the manufacturing sectors, corporate buyers are still the biggest percentage buyers. That's 44%. But when we get into private equity add-ons represent 24%. Private equity platforms represent 20%. So 44% in total. But it also shows you when you see private equity add-ons are bigger than platforms, it means that private equity's been in that space for a while, and now they're looking, a lot of those private equity firms are looking to add on to their investment. So certainly manufacturing, a key part of the economy. And so I think that's important to understand as well. What's interesting here is that 12% represents individual purchasers. So that is also very interesting. And I think also what's interesting about this breakdown is that there's a lot of potential here for synergistic and strategic buyers, especially when you look at private equity add-ons. Certainly corporate buyers could be looking for strategic add-ons. It's hard to say with individuals. They could be mostly financial buyers, but it's hard to say. Maybe if they're wealthy enough, they have a portfolio of companies. So let's move on to business services. So again, here is actually an even breakdown between corporate and private equity platforms. So each of them represents 41%. So that's, in total, 82% of buyers are going to be either corporate or private equity platform. We don't see a lot of private equity add-ons, only 3%. So that just shows you sort of probably a big space that private equity is moving into, but has probably not been there long enough that the add-ons are a significant part of the deals right now. So we mentioned that construction and construction materials has kind of moved up in importance in terms of the number of deals. 48% of buyers are still going to be corporate buyers. 13% are private equity platform. And 9% are going to be private equity add-ons. So private equity, if you combine them together, it's going to be 21%. Also big there is independent sponsors, represents 18%. So I think that's kind of an interesting space. I think that's the largest, one of the largest certainly sectors where independent sponsors to be involved with. And again, I think infrastructure type of companies, certainly a good type of company, I think, that can weather recessions. So I think that's probably part of the attraction there. And obviously they can be good cash flow businesses, probably have very sound contracts. So that's part of the appeal. Moving on to business services, B2C, 50% of buyers are going to be corporate. Private equity platform represents 22%. And again, individuals, I think this is the largest representation from individuals, but they represent 21% of buyers. So that's very interesting that this is going to be, if you are seeking out individual buyers, it's B2C services are going to be the area that you're most likely going to find that kind of activity. Moving on to software and software as a service. This is also kind of interesting because we see a very even distribution amongst different types of buyers. So corporate buyers here, a lot of the other sectors, corporate buyers represent about 50%. Here it's only 28%. Private equity platform is 18%. Private equity add-on is 27%. So again, this is something that private equity's obviously been heavily involved with over the years. So they're looking for add-ons. And what's interesting here is that family offices are obviously very heavily involved. This is the largest representation. 27% are involved with software and software as a service. Let's talk about prices. Prices and valuation and deal values are based on the respondents. About 50% said it's going to be it's about the same compared to 2020, but you can take a look at on the higher side, basically about 35+% of the respondents have basically said that the valuation is higher, and about 15% said the valuation is lower. So the upside is there basically for either the same valuation or higher. So I think that's a positive development in terms of factors that are driving change. And the main positive impact is going to be the outlook of the seller's industry. So if you're in an industry where the outlook is strong and people are confident, then that's going to positively impact the multiples. Some other key factors would be the seller's pro forma financial forecast, so future anticipated cash flows. Qualitative factors such as financial management, the ability to pivot and adapt strategically. That's also a key factor. And we look at sellers' last 12 months P&L performance. That's also a big role, because the numbers that you're actually really putting up are going to be very objective. So what are some of the potentially negative factors on valuation? Well, the biggest one really is sellers' profit and loss performance. And if you see them, if you have a company that has not done well during COVID, especially kind of faltered post-COVID, then that is going to have obviously a negative impact on valuation. And also things. The balance sheet is often sometimes overlooked, but impairments to the balance sheet is also something that could have a negative impact on multiples. Now, are deal terms increasing or decreasing relative to the end of 2020? And the major things that have become tighter and more restrictive are going to be rep and warranty terms, working capital requirements, rep and warranty insurance, escrow amounts, and escrow duration. But it's also important to keep in mind that it's going to depend on the individual businesses, the buyers that are involved, and just the specific industries that you're dealing with. So, for example, for some deals, escrow amounts and durations have actually improved. So, also exclusivity periods have, for the most part, that's actually a major factor in terms of that have been sort of improved or shorter requirements, less onerous requirements. But overall, I think we can say that for all these categories, everything's pretty much stayed the same. So what areas of due diligence have kind of changed in terms of importance? This is a really interesting slide here. So the number one focus right now in due diligence is customers, and financial is number two. This is kind of flip-flop from what we saw in December 2020, where financial was number one and customers number two. And I think financial probably was critical at the end of 2020 because you were dealing with a lot of companies that had gone through COVID, and I think there was a lot of focus on quality of earnings and what you're really buying. And I think we've come far enough now, even though we're still sort of within the pandemic, but hopefully maybe at the tail end of it, that the financial end of things is always going to be important. But I think what people are now focusing in on, and it's really a return to what probably existed pre-COVID, is that want to take a look at customers. We want to take a look at customer concentration and customer satisfaction. Those are things that are all incredibly important. So I think that tells you a lot about maybe the sentiment as we move through the pandemic. So other things that are important, obviously, management, the management team, key employees. When we talk about sales, we talk about the sales process, and contracts are always important because you want to know, like, do your contracts, how far into the future do your contracts run? Can your revenues just fall off a cliff in short order, or do they extend out several years? Other things that were important in terms of the due diligence process are IT, cyber and data security, and vendors and supply chain. And I think that these things are always going to be important. But what's also important is that what were some of the big changes? And the reality is that IT, cyber, and data security was probably one of the biggest increases in terms of importance over the last 6 months. Also, sales and sales processes, probably those two were the largest increases. And I think we can see it here that IT in all sorts of different areas, including systems and networks, operations and development, the biggest increase in importance, and just sort of understanding, understanding what's supporting the infrastructure of the business. Obviously, things such as customer intelligence, business intelligence is important. So the IT systems are really important for that. And of course, if you've got any sort of business that's trying to grow, does it have the IT to support it? So what were some of the motivating factors for sellers? I think this is kind of consistent from report to report, but the age of owners, impending retirement is a big motivating factor. Also, a big motivating factor is going to be personal factors, health, family, etc. And that's important, and I want to emphasize is that these are things that are very specific to individual owners, and it's the reason why exit planning is so important, because all these things can change. For example, obviously we're all getting older every year. Your perceptions about when you want to retire are going to maybe change, but your situation with your health is maybe unpredictable. Situations with your family may be unpredictable. So we do exit planning because we want to be in a situation where we're not waiting till the last second to do some of the stuff that's important, critical in terms of preparing for retirement, succession planning in case something goes off with health or family that impacts the business. We see this time and again, every single report. These are key factors. Some other things, I'll say this isn't a very American-centric report, so talks about anticipate tax law changes. So that's really making reference to the Biden regime, but it's not necessarily applicable to Canada. Although we just got out of an election here, so I think you will see some people who are definitely there may be some things certainly in terms of, like, say, capital gains that may transpire over the next 2 to 3 years as we're dealing with a new liberal minority government. Other factors that motivate sellers are going to be the M&A market outlook, which is quite positive, and economic outlook and conditions. So you can see some of the other factors there as well. For the most part, I would say, outside of the tax changes in the U.S., the M&A market outlook is sort of a big change. So it is, I think, people are generally feeling more positive about the market. So I think that's a big influencing factor in North America. Okay, so looking forward, what factors are going to impact the deal flow the most? And really, in terms of positive impacts, seller motivation is a very, very strong factor. So, that's almost like 80%, actually close to 90% of the respondents said that the seller motivation is going to play a big role in the deal flow for the rest of 2021. Buyer motivation, also very positive. I would say in terms of factors that are probably a little bit more negative could be the rate and shape of economic recovery. So I think that's a bit of a mixed bag, and we're definitely seeing continuing impacts from COVID. It's a little bit more negative or neutral, and the percentage of respondents that were positive about it were relatively small. So still a lot of angst and trepidation out there. And what's important is how do respondents feel that prices are going to, what direction prices is going to go. And so 47% say it's about the same, but a vast majority are either neutral or positive. You can see that over 40% believe that prices will be higher by the end of the year. So that is something that is very positive if you are thinking about selling your business. So let's just kind of summarize everything. So in general, the deal flow has increased in 2021. I think the sentiment has increased. And, much like other periods, corporate and private equity buyers are dominating. Depending on different sectors, some of the, you may get some individuals, you may get family offices involved, but for the most part, it's pretty consistent that corporate and private equity are involved with most of the sectors. Valuations are trending positively, but it's important also that this could be a bit of a bifurcated situation. We're looking at the market as a whole. So again, very good businesses. Obviously, you're going to see an increase in valuations, but for businesses, I think that have struggled financially during the COVID period, that's going to increase the perceived risk from buyers, and that may result in lower multiples for those businesses. In terms of due diligence, the biggest thing that's kind of changed is really a lot more stringent look at IT in terms of not just security, but also like on the operations side and every aspect of the business, because it's really all about the infrastructure and supporting the scalability of the business. And as we always see, personal factors such as age, retirement, family, liquidity continue to play large roles in seller motivation. And this supports the idea that exit planning is not just important, but I would say critical task, because these cannot be addressed, with a short time span. You need to give yourself enough runway to address those issues when you're dealing with, family, dealing with your own personal goals, etc. So that concludes my presentation today. We'll be back in another 6 months with probably another take a look at the sort of the end of 2021. But everything looks relatively positive now, so we'll see in that time span if that comes to fruition. Anyways, thanks everyone. Have yourself a great day. Talk to you soon.